Good morning, good afternoon, good evening, everyone, and welcome to Gain Traction While Mitigating Risk. My name is Michelle Eisenberg, and I am a program assistant at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. And so, as you will see in the chat in a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs, regardless of race, industry, or geography. So check out those links and resources in the chat. And then just a couple of housekeeping items before we get started. First, let us know where you are dialing in from in the chat. Second, we are going to open up for live Q&A at the end of the event. So please make sure to submit your questions for us in the Q&A function at the bottom of your screen throughout the presentation, and we will try our best to get to all of them. And of course, none of what we do could be possible at the center without all of the amazing support from our sponsors, including NASDAQ, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We are humbled by their contributions and hope you are grateful too. And so before we get started, we always like to launch a couple polls just to see how everyone's doing today. So this first one is going to ask, how are you feeling? Fearful, anxious, surviving, or optimistic? Give everyone a few moments to submit a response here. Awesome. Texas, California, Tennessee, India, Abu Dhabi. Welcome, welcome everyone from around the world. Thank you for being here. All right, I'm going to end this poll and share these results. Optimism is in the lead. We always love to see that, but we got some feelings of anxiety and surviving as well. I'm very confident our conversation might help with some of those feelings. I'm going to stop sharing this poll and launch the second poll. What is keeping you up at night? Finance, sales, marketing, scale, pivot, team, or surviving? And this one helps us understand your current entrepreneurial needs so we can continue providing relevant programming. Give this one a few more moments. DC, Iran, California, welcome everyone. So great to have you all here. All right, I'm gonna go ahead and end this poll, share these results. All right, we got a good mix here. Finance in the lead, marketing and team close behind. All across the board, though, I think we'll kind of touch on a lot of these topics during this conversation today. So I'm going to stop sharing this poll. And without any further delay, please join me in giving the warmest welcome to our special guest, Jason Malki, founder and CEO of StartupBoost.com and co-founder and CEO of Superwarm.ai. Jason, it is so great to have you here. Thank you for joining us.
Thank you so much for having me. I'm super excited to be here.
Awesome. You want to just give people a little intro to who you are and what you do?
Absolutely, absolutely. So I've been in the tech startup space running an organization called Startup Boost for a little over a decade now. What we've done for the first couple of years of our business was we were essentially a event series, right? So we did mixers, panels, investor nights, expos, and we essentially A/B tested that out to see what type of programming our community enjoys. Fast forward to today, we have about 30,000 people on our newsletter, another 30,000 across our socials, collectively about 60,000. And we still do tons of events. We have 2 events coming up in New York City next month. One's like an investor-focused mixer. One's a startup founder-focused mixer. We're going to be doing pitch events, kind of like Shark Tank style. So that's one element of kind of my background. And then just to kind of wrap Startup Boost up, over the years, we talked to thousands of founders and investors and noticed in that pre-seed to Series A especially, there's a uniform set of needs. all the startups need deck design. They all need to, meet investors or, help with their digital marketing. So after having thousands of conversations, we ended up creating a complementary Startup Boost agency that essentially complements the events and ecosystem that we built. Then last thing in terms of my background, with all that experience, we've actually now launched our own platform. We're actually in the private beta at the moment with a couple hundred signups. Essentially, it's called superwarm.ai, and it connects founders and investors for meetings as they raise, again, usually in that pre-seed to Series A. So that's kind of quick background on myself. Been in this space for about a decade, worked with hundreds of startups, seen a lot, learned a lot, and hoping to share some of that with the audience today.
Awesome. Thank you so much.
Yep.
All right. So in this discussion about gaining traction while mitigating risk, we're mainly focusing on kind of like optimizing your go-to-market strategy, your sales strategy, and your fundraising strategy. So I'd love to start out by kind of getting a better understanding of how and when early stage founders might think about aligning and prioritizing these strategies, like depending on the circumstances they find themselves in with potentially limited resources and team or network support.
Definitely. So just in terms of like when you're first starting up, I'm going to kind of take it like how I think about the genesis of that process. So first things first is obviously team, right? And there's many ways to slice that. You could be a solo founder who maybe has a certain skill set. Maybe you're good at sales and business development, but you don't have the tech skill. If that's the case, you have two options, right? One is find a technical co-founder, give us some equity, or work with a dev shop, for example, or a freelancer. So that's kind of the first question is like taking, and again, it depends on if you came up with this idea on your own, if you thought of it with somebody, but almost taking stock of like your skill set and figuring out, hey, what do I need in like a complementary manner for us to get to the point where I can take this idea and what types of people do I need around me to make it a reality, right? So that's one thing, right? Second thing that I think about is even before you get into like marketing or even like before you go too deep into product market fit, it's like just thinking about like what you're solving for, right? Like figuring out, okay, I'm going to solve for X, but you might have like a general idea, but more than just like, hey, it's a nice to have type of idea. Can you like really think through like a really hard problem and really start to like zone in on that? Once you have that, then my mindset's like, okay, then you start to go into product market fit, right? And you can do things like surveys, et cetera, that are low cost. But so my point being that kind of first tranche I just mentioned is almost the idea of like measuring twice, cutting once in the early stage. Just being like, all right, I have a solid team. I have like a validated problem I'm looking to solve. I'm going to do some like low cost and no cost type surveys just to like make sure that whatever I'm about to commit to like makes sense. Because you got to remember, when you start a startup, it's a lot of your time. It's a lot of your resources. Some people leave their day jobs or jump in the opposite direction on some other project they're working on. So it's like if you're going to make this jump, it's like really like make sure that there's something there, in terms of your efforts. Because again, there's a lot. One thing I will say, talking to thousands of founders, is there's tons of talented people. To be quite honest, some of them are working on the wrong ideas, right? So that's kind of my biggest thing. And then from there, I mean, in terms of like marketing, funding, etc., to me, those become almost like natural progressions once you kind of get that first tranche taken care of. So once you kind of cross that bridge, my second thought process would be kind of one of the things you mentioned, which is like marketing. We can probably go into more detail and follow-up questions, but from there, I'd say marketing becomes kind of the next thing once you start to find that product market fit and kind of validate that need in the market. And then from there, it's like, okay, I have some proof of what I'm building makes sense and it's valuable. Then you start to go out for financing or funding, right? But yeah, I mean, look, you could get some funding at the idea stage, maybe based on like, relationships that you might already have. So whether that's family and friends, or if you're somebody who's had a successful exit in the past, you might be able to raise money on like at the idea stage. But I would assume most people in this chat and just broadly are probably this would be the first time being funded. So if that's the case, I'd say, it's a matter of creating enough proof that you can start to build rapport with investors who will eventually finance things. And look, there's no shame, and I did this, and I'm still technically doing this. There's nothing wrong with having, it all comes down to bandwidth, having essentially a day job while you work on your startup, right? Like even when I first did Startup Boost for the first couple of years, I worked at startups during the day, and then nights and weekends I'd work on Startup Boost, the events. And eventually I said, okay, I can build an agency that can subsidize my time, and then I don't have to work at startups, right? So even if you're someone in this chat who's like, hey, like I have this pretty solid job, but I want to do my startup, look, you're going to be in a better headspace if you have a check coming in every month while you build. If you've already made that jump, Obviously, a lot of us have, and I don't, not say that doesn't work, but I'm just saying everyone has a different scenario. So don't feel like, I know some of the mentality is like, oh, go all in, drop everything, like take a huge risk. It's like, analyze your situation. Some people can do that, some can't, right? So just, don't feel like you're pigeonholed into any preconceived notion of what it is to be a founder. Like just think about your scenario and then kind of act accordingly. So that's kind of how I think about it end to end. It's like kind of get your ducks in a row. Then once that's kind of there, the product's in a solid kind of space in terms of validation, marketing, and then fundraising. And I think it's all kind of complementary. It's almost like graduating to different levels, if that makes sense.
Yeah, that's super helpful. And I also just love the emphasis on like taking that time early on to clearly define what you do, why you do it, and how it's going to get done in a sustainable, scalable fashion. So that's just a great framework that entrepreneurs can kind of follow as they're thinking about prioritizing these goals for themselves.
Definitely.
So kind of touching then on product market fit, what are some of the key factors that contribute to finding product market fit, and how might startups leverage these insights for a successful go-to-market strategy?
Yeah, I'll give you a literal example because it's what I'm going through right now with Superwarm, and I'll take from some of the other stuff I've seen as well. But before I even get into the case study, I guess, of Superwarm and how I'm doing product market fit, I will say one of the biggest issues I see with startups is that they don't have product market fit. They're pouring all their time and money and energy into something that has not been validated. And that sometimes seems like, hey, I'm just gonna be doing it for a short time period. Ends up becoming 2-3 years later, you still don't have product market fit. You're draining all your resources, and now you're just in this frustrated spot. So in terms of product market fit, I mean, I cannot stress enough how important it is. And look, to be clear, you're not gonna get your full on product market fit figured out before you launch your product. You got to get out there. You got to talk to customers. You have to iterate, optimize, of course. But in the early stages, there's ways to contribute to that product market fit at essentially no cost, right? So for example, the example I was going to mention with Superwarm is seeing so many founders, in my opinion, make that mistake. And the reason it's frustrating is because there's so many talented people, again, that are sometimes working on stuff that if they're working on the right idea, they could become a unicorn, but they're just not because they didn't validate the idea. So one thing I did with Superwarm is, I do, I guess, have the advantage of I've been building a network for a decade, so I have open line of communication with a lot of founders and investors. So within about a week, I ran a free survey. I pulled up I think I used Typeform, so I had a subscription. You can use Google Forms for free, right? I came up with I don't know, 5 or 6 questions, right, about the product. I sent that out to hundreds of people in my network. Within a week, I had about 43 founders and 35 investors in that pre-seed to Series A fill out my survey. Okay. And it validated a couple of ideas that I had around the product. I even had a comment section, what do you recommend, where they gave me a couple of really good ideas, right? And I even had certain questions where I asked about pricing. Hey, if I were to give you this value, would you be willing to pay for it, right? So for me, and funny enough, the first check we got was from a venture studio, Alpha Ventures. They invested us based off the survey. They filled out the survey, and funny quick story, David Perini, one of the partners there, he's like, hey, Jason, we actually have 1 check left you have to deploy by the end of 22. He's like, I know you've been in the space forever. You have a lot of connections. He's like, we want to take a bet and invest. So he seeded 50 grand, which is great. They gave us enough to get the product going and everything else. So from a survey, believe it or not, I raised my first check, right? Because so that, that's a I don't want to say an anomaly, but I kind of got lucky. But nonetheless, it's it also gave me confidence. Before I ran that survey, I was like, do people really, would they even use this? What are some of the key factors that would actually get them to look at the deal flow that they receive? And by doing the survey, it just I mean, for example, I had a straight up question. If we created a platform that matched founders and investors based on vertical stage, traction, etc., would you use it? That was my very basic first question. Out of the people who filled it out, 94% of startups said yes, which I kind of expected that to be high. But on the investor side, I was a little worried. I'm like, oh, they get deal flow from different places. Do they really need this? And it was about 72% of investors said yes. And that's, to me, the hard side of the marketplace. So for them to be above 50%, that just gave me this level of confidence where I was like, wow, I feel like with what I end up going to market with, and again, going back to my point of product market fit's not going to be figured out at the idea stage or within the first couple of months completely. But if you can get some validation early on and know that your MVP is going to drive some value, then you can start layering things on it and really strengthen that product market fit. So to me, I mean, to answer the question full circle, again, a no-cost solution is surveys, right? Another thing is beyond surveys, just talking to the early users, right? So for example, even in this process with what I'm doing, I'm on the phone at least a handful of times a week with either an investor or founder from our platform, just being like, hey, can we hop on for 15 minutes? I want to gather some feedback, see what you like, what you don't like. And I even survey them intermittently. So it's not like something where I've stopped doing that. Like it worked really well early on. I'm continuing to do so. And, coming full circle more broadly beyond what I'm doing, this, in my opinion, applies for almost anything. You're doing something in the health tech space, figure out how you can get surveys from doctors, right? And look, it's a hustle. Nothing's easy, right? So you got to, you have to, cold email. You have to, go to a family connection who's a doctor who knows a couple other doctors and ask for a favor. Like you got to hustle and figure out like how to get these responses. Again, I will say I had a little bit of an advantage because I've been in the space for so long. But maybe you throw in if it's a financial services player or fintech, maybe throw in invite them to an event or you warm them up a bit. But my point is, there's ways to get these surveys filled out. You just got to kind of hustle and figure that out. And now coming full circle to the go-to-market, how that applies. Like for me, you can do a couple other things during the surveys. You can even ask questions that help you to define your personas, which could lead to your go-to-market. So for example, you might say, hey, is this built, what I'm doing, is this more of an enterprise play? Is it more an SMB play, right? And then you survey both, right? And then see where there's more buying. And then from there, you're like, all right, in my go-to-market, I found that enterprise, like this is more applicable. Let me focus my messaging, my targeting, my PR play, whatever I'm doing to that enterprise demographic. And maybe later we can try to layer on the SMBs. So like, yeah, again, to me, like the best thing is to, at no cost, do surveys, hustle, get that done, right? Again, not saying it's going to be easy, but that's part of being a founder, being an entrepreneur. You've got to figure that out, right? From there, take those insights, like really understand what they're communicating to you. If you're very friendly with some of the respondents, maybe try to get on the phone with them, review the survey with them. Again, like this isn't stuff that scales or is even that comfortable for some people. But again, if you want to measure twice, cut once, you kind of have to do these things. But to your point, Michelle, like it trickles into the go-to-market, right? So there's that benefit of doing it the right way that will also save you a headache in the future and put you on a more likely track for success. There's no silver bullet. Everything's incremental, right? Like, folks, I did the surveys, I have a 5% chance more of being successful. I did the go-to-market rate, increased me by 3%. You do 10 things right now, you're 30% more likely to be successful. So to me, that's how I think about it. It's like you got to kind of build up kind of these results. And yeah.
Yeah, that's super helpful. Love the emphasis on taking the time to validate the concept, and just staying on that point of customer engagement and feedback for a moment. Just thinking about these early stage founders who may have a limited network. What are some ways that they might kind of, approach their strategy to gather feedback in a way that encourages those who may be outside of their network to care about what they're doing and take the time to kind of give that feedback when there's not that previous connection?
Yeah. I'd say like, look, the way I've built my network, my connections, I mean, even back in the day before I started Startup Boost, I used to work in the family business in Jersey, and I would hop on the bus twice a week, go on an Eventbrite, find like free events, just go network. I didn't even know what my agenda was. I was like, let me just go meet people. I think, the tech scene's cool. I want to get involved. So whatever your vertical is, I mean, Eventbrite, there's events for every vertical at this point. There's healthcare events, there's business events. If I were at that stage specifically, I'd go to as many, even if it's just the free ones. If you have a couple bucks in the budget, go to maybe some paid stuff. But me, I was like in college, I was just going to the free stuff, right? But like that's a way to do it, right? Just literally get in front of people, go to these events, grab some business cards, be like, hey, so nice to meet you tonight. I'm actually running a survey for a project I'm working on. Would you be up to fill it out? You ask 10 people at the event, I'm sure at least half will do it because they have a face, right, that they've met and they've shook a hand. So I'd say if you're around like a bootstrap budget, and especially if you're like in a major metropolitan, it might be a little tougher if, I don't know, if you're like somewhere in part of the country where it's just there's not as much economic activity, that might be a little tough. I mean, there's even virtual events now where you can network. So I feel like there's ways to figure it out. But yeah, my opinion would be again, not scalable, but going to events, building those connections and starting to get on that. Because think about it, if you're surveying them, they might eventually become a customer anyway. So it's like, why not plant that seed and be like, oh, I remember, Jason, when you're working at that thing at the idea stage. Wow, it's built, it's working. Yeah, you know what? I'll sign up for the $20 a month. Cool. Let me check it out. I've seen you kind of grow from idea to product. Cool. So there's that also, you're building that network that could also benefit the product beyond the survey. That's how we got it. By the way, our early users, most of them were from the survey,
Right.
right? So,
Right.
yeah.
That's awesome. I love it. So kind of switching gears a bit,
Yeah.
thinking about like differentiation, how might these early stage entrepreneurs kind of like take all of these insights, that they're gathering from customers and, other market insights that they've gathered, how might they use that to differentiate themselves in a potentially competitive landscape, considering they may have limited resources and the target market's limited awareness of their business?
Yeah. So in terms of like leveraging some of those insights, I mean, again, not to harp too much on surveys, but maybe that's part of it. It's like, okay, how are you currently solving for X? And you might see them bring up the same competitor in every other survey. So then it's like, okay, you look at that thing and you say, all right, can I compete with this thing? Or do I need to almost like pivot my product to an ancillary solution in this space that I can build a business on? And then maybe down the road, I can loop back to that feature that directly competes with them, right? So it's almost like, hey, that's the way I would think about it. Like, all right, can I find almost an ancillary solution within the space that could get me traction and use that as almost my Trojan horse? And then once I have the user base, and look, full transparency, that's kind of what I'm doing with Superwarm, right? Like right now I'm doing the investor founder matching because I know that that's gonna be a lot of founders to sign up because they want to meet investors. I just know that's the reality. And that's how it's been working out so far. And eventually I want to layer on other things. But if I came out and I said I'm a service marketplace and I had zero founders, like eventually to let the cat out of the bag a little bit, eventually we want to do stuff like that where it's like, hey, not only can you get funding on our platform, you can go hire a freelancer or an agency, right? But I'm not going to start up with that because there's so many people doing that. And to your point, like I know that based on my research. So I'm like, I'm not going to start there. So that's like one way to think about it. Also coming full circle. So I think you had asked a bit about like how to compete in a marketing way with limited
Yeah.
resources.
Mhm.
And like, okay, so one thing I'm very big on, there's actually a book I would recommend to pretty much everyone on the call. It's called The Cold Start Problem by Andrew Chen. He was in charge of driver acquisition at Uber, and they spent about $1 billion a year on working to acquire drivers to the platform. And essentially, you probably have heard about this program. What they would do is, hey, if I'm a driver and I refer Michelle, we both get $200, right? Because for them, based on what they knew, the drivers were the hard side of the marketplace. So that incentivized that. To come in full circle, number one, that book's really good because there's a lot of stuff that you could apply in the early stages at like low to no cost that they recommend. So for example, again, I don't want to keep pointing back to the product we're building, but it just relates to the question. I don't mean to be promotional. It's exactly aligned with it. So for example, with Superwarm, what we did was like, for example, actually this week we're implementing something, what you call a network effect, right? So for example, when someone fills out their profile, yeah, that's the one. When someone fills out their profile, the last thing after they fill up all their data is like, hey, do you want to invite Google contacts to get free introduction credits? Because we have like an economy around like introductions. So now all of a sudden, if I get 5 friends to sign up, I get 5 introduction credits like I used to meet investors, right? So now I'm taking that founder that I'm making this up cost me $1, and I'm getting 6 users out of it, right? So whatever the math is on that, right? Less than 20 cents a conversion, right? So like that's a network effect. It's like getting your users to essentially be your marketers. Another example, like that I actually was in the book. I don't know if they mentioned this one specific. Oh yeah, they did mention this Dropbox, right? So for Dropbox, what did they do? When I got Michelle to sign up, we both got free storage, right? So like in the Uber situation, they actually were giving cash. In the Dropbox situation, they were giving product essentially, which is way lower cost. So if you have a product where you can essentially incentivize the founders, or sorry, the users to share it out, that's what you call network effects. And that's super powerful on a smaller budget because think about it. If you are able to create a good, strong network effect within your product, every user is going to amplify, right? So if you can kind of figure out that within your product, especially even in the earlier stages, that's going to bring your cost of marketing significantly lower. And then one thing to kind of tap on top of that, which is also mentioned in the book, they talk a lot about atomic networks, which are like these small networks early on in the product. So for me, it's like me going to my existing network that I got into the platform through surveys. That's like a little atomic network of users. And the short version of it is that when you first launch and maybe you're on a budget, the way I think about it is how do I tap into other atomic networks? So let's say you're in fintech. Is there a fintech newsletter? Is there a fintech meetup group? is there like these existing atomic networks that you can tap into, right?
Mhm.
I mean, obviously you have to get creative, but maybe there's something there where you can offer, a discounted access to your platform to the person, or free access to the platform to the person who runs that fintech group, or hey, you know what, I'll actually help you host the next event. I'll be like boots on the ground with you. Just do me a favor, can you mention us in your next newsletter? So now you're tapping to their atomic network. There's actually I forget the name of the newsletter, but there was a guy on Twitter the other day using the same strategy. I have 60,000 on my distribution.
Mhm.
His Twitter said he had like 40,000. I know it's a different conversation, but I DM'd him. I said, hey, like we have pretty good distribution. You have good distribution. We'd love to barter and promote each other's like your newsletter and just promote what we're doing. And
Mhm.
he's like, you know what? Come out. He's doing a mixture next Wednesday. He invited me out to come to it. So I'm gonna go meet him now and hopefully like do a cross promotion. So coming full circle, like if you're bootstrapping, a couple things I would think about is when you build your product, try to build the network effects into the product. So again,
Mhm.
it can be as simple as when they finish signing up, incentivize them to invite their Google contacts if you have a Google login. Maybe there's a refer for credit, a refer for something program within each account, right? They click that button, they get a unique link, they get someone to sign up, they get X benefit, right?
Mhm.
Like another example is like DraftKings, like the betting app. If someone
Mhm.
comes to me and gets me to sign up, we both get a free bet. Doesn't you know what I mean? So if you could think through your product and think about how you can do that, it's really powerful.
Mhm.
And then again, if you can tap into existing networks and get savvy around that, where it doesn't have to be too much coming out of pocket, that's another really, really powerful one. One other thing I just want to highlight broadly, Michelle, just in
Mhm.
terms of like marketing mindset, is I think of marketing in four columns. Okay, there's getting the lead's attention or the customer's attention, right? That's one thing. That could be a newsletter, that could be social media, that could be a cold email, whatever it is, attention. Then you got to work towards conversion, which is the second column. Get them to sign up for free, get them to pay for something, whatever it is. And I will say a lot of startups end up doing a decent job there, right? And they end up, once they kind of figure that out, put some money behind it as they get funding or scale. And this is kind of like a heads up. The, the second half of it is what's necessary to have a good, strong marketing engine. And,
Mhm.
and the reason I'm bringing this up in relation to what you asked is because I think you should think about this from day one. The next two columns are retention and propagation. So what does that mean? Once you convert them, you have to keep them as a user or keep
Mhm.
them subscribed, right? Because otherwise, you're going to keep spending money on attention and conversion, and it's going to be a leaky bucket, and you're going to have a really low LTV or lifetime value. But if
Mhm.
you have good retention, you have certain retention mechanisms, and the simple one would be like, say you're a platform, maybe you send a weekly digest of, hey, this is how many interactions you had on our platform this week, and you have this message waiting in your inbox. That's technically a marketing email that they don't even realize is a marketing email. It's a retention email, right? And then
Mhm.
propagation kind of goes back to everything I just spoke about. Just have certain programs where they can easily invite friends and family or incentivize that share. So to me, it's like if you can get attention, conversion, retention, and propagation together,
Mhm.
you have a real marketing engine. And those are things that fundamentally you can do from day one. Obviously,
Mhm.
you can improve those different columns and the way they operate with more capital in the future. But while
Mhm.
you're validating it early on, if you can at least be in that mindset and kind of apply that where you can early on, you're going to have just a stronger set of users and subscribers that even the early stage could eventually be like the power users, right? So sorry, we kind of went off on a rant there, but just wanted to kind of mention that.
No, yeah, yeah, yeah. That's awesome. I want to dive deeper into kind of like those channels.
Yeah,
But I want to quickly just touch on like, I love this idea of kind of like tapping into the networks or the established markets of, a strategic partner. So can you maybe dive a little bit deeper into some of the ways that these strategic collaborations can help startups overcome some of their challenges or like some of those
yes.
common challenges that they face at that stage?
Yeah. So one thing I'd say right off the bat is having a clear set of actions for the partner.
Mm.
So, for example, I actually talked to a startup yesterday. He created this community for like inventors who create like physical goods, and like I do more software. He's
Mhm.
doing more like inventions, and like we were going back and forth on how we could work together. And I said, listen, the lowest hanging fruit is let's do like a newsletter swap. We
Mhm.
want to do a bunch of other stuff, like events together, whatever it is. But I'm like, you know what? A newsletter is easy. It's a way
Mhm.
for us to, it's almost a wedge to start the relationship, right? Like we've, traded some emails together. We've done some light work together. Now there's that comfort level. Then it's like, hey, what else could we do? So, but for me, it's like, think about, again, what value you can provide to someone. Because especially in the earlier stages, they're probably gonna have the leverage, right?
Mhm.
So you could, like a thing I've done in the past with like bigger newsletters earlier on is like click parity. So what does that mean? Let's say when I was at 10,000 subscribers on my newsletter, I went to a group that had 50,000. I'd say, hey, listen, I'll do 5 newsletters. You do 1 for me. Click parity, right? It's equal. So
Yeah.
even like, getting creative around like providing that value. But I say the biggest thing on those partnerships is like, obviously you can get creative during the session, but try to be prepared with like a set of like an offer that would excite the other side of the table. I mean, look, an easy one would be, and again, nothing works 100% of the time, but I've done this for clients. That's why I'm bringing it up. It works pretty well. Even if you have like little to no following, if you create now on medium.com for like $5 a month, you can create like a publication. Or even I think podcasts are good too. Don't get me wrong; just a little bit more bandwidth heavy. But for example, if you do like in interviews, so for example, I'll say, hey, headset just came off. Just a second, plugging that back in. Got a little too excited. So
All good.
yeah. So in the publication, what happens is I have clients all the time. They come in, they have literally no followers. I'm like, listen, you're in the metaverse space. Let's create Metaverse Weekly. That's the name of your publication, or Metaverse Digest. I'm making this up, right? Then we'll go on LinkedIn, and again, this is even if they're super early stage, low budget. Again, medium's $5 a month. Hey, recently launched a publication called Metaverse Digest. Notice that like you're the head of metaverse at Nike, or you're a startup in the metaverse space, or a metaverse investor, whatever, right? But being like, hey, I'd love to hop on a call and actually interview you, like in this publication, right? And this is kind of a bit of a hack, but the way I do it to protect my bandwidth is like, because we do this ourselves, like for our own business, we have our clients do it. But when we get on the call, we say, hey, listen, in terms of the publication, it's totally free of charge. It lives on Google. We're very link friendly, all that fun stuff. One thing is, because bandwidth's at a premium, I'm building a startup, I'm doing this publication. I don't sit here and do a live interview. I kind of want to just talk to you today on the call to come up with questions. Then I'll send you the questions in a Google Doc, and you send back the answers with like a professional photo. So essentially what ends up happening is these decision makers in your space end up becoming your marketers, right? Like, so, and coming full circle to the point of like tapping into partnerships, you could use that same tactic with your publication to go to someone who runs, if you're in the fintech space, a fintech meetup that you want them to, talk about your app or give you a spot in their thing about your app. So just like doing things like that, again, low to no cost, you're able to spin up a publication, use that as an authority, even if you don't really have much yet, to start to position yourself as an expert. And, and then what happens a lot also that's cool is that a lot of those thought leaders, when you feature them in something, what do? They share it with their networks. If I have a SaaS sales software and I interview a VP of sales, when they share it on their LinkedIn, it's going to get 50 or 100 likes from their own atomic network, like we talked about. And who are going to be most of those likes coming from? Other sales directors, VPs of sales, etc. And essentially, they're becoming your marketers. They're tagging your company about the interview they just did with you. So again, you don't need to have really a following necessarily to do that. You don't need to necessarily have a big budget to do that. But you could use that to build those strategic relationships that lead to strategic partnerships that maybe lead to those borders in the newsletter, or hey, I'll do the interview, you put me in your newsletter, it goes up to 20,000. Right. So again, I think it comes down to like being kind of creative and scrappy early. There's ways to do it. You just got to be a bit strategic in terms of like, who you deal with, how you approach them. If you kind of do a spray and pray where it's like, hey, give me, it's going to be a hard time. You got it, especially in the early stage when you're smaller, you got to be in give mode. You should be in give mode at all times, even in the future when you're hopefully successful. But I'm just saying early on, you got to be extra. They really got to give,
Right.
So,
yeah, that's super helpful.
Can I throw in one more? Sorry, I just have one other one that.
Yeah, absolutely.
So like another one, and this actually is how I started to build a lot of relationships, was hosting these people at events. So like with Startup Boost, let me take a step back so this actually works for people in the way I explain it. When I first started doing Startup Boost, I wanted to really grow the newsletter because I had a decent following, but I wanted to get to the next level. I would do a lot of mixers in New York, right? So I do free mixers, put them on Eventbrite, Meetup, wherever. And I have some mixers where I get 500 or 1,000 signups for like a business mixer. And I take those and start adding them into my newsletter, which eventually grew to 30,000. Now coming full circle to the idea of like how that could benefit someone who's bootstrapping is that I eventually started doing panels. What I would do is say, look, I'm going to do a panel. There might be 40 to 50 people in the audience. I may or may not get value from the audience, but I know those 4 panelists I invite to speak next to me about health tech. Each one of them is a CEO of a startup that has at least $2 million in funding. So I could turn to them after the event and be like, hey, by the way, Startup Boost does services. And maybe I convert one of them to like a retainer. So again, that's like another kind of scrappy way. It's like, hey, if you host a panel, have panelists who are big time decision makers or who control a big newsletter in your space or something to build that
Mhm.
relationship, or even do something virtual. Doesn't really matter. But again, use that as like a Trojan horse to start to build a relationship.
Mhm.
So anyway, some thoughts.
Yeah, no, that's awesome. So many great ideas there. And I think, it can, on as entrepreneurs, like we often go to like those common strategies. And it's good to kind of be thinking outside of the box and get creative. So I love that energy. So then kind of moving to that sales and marketing distribution channels, what are some common pitfalls or mistakes that founders should be aware of when establishing those channels, and how might they avoid them?
Yeah, so I'd say the biggest issue that I see, because we actually help a lot of teams with their sales, like building out their sales process. So a lot of times people come to us, founders selling essentially, where the founders doing all the selling, and they're like, hey, I need a sales development rep, I need an
Mhm.
account executive, I got to build that out. Problem I find a lot, it's almost similar to product market fit, but on the persona side. So what does that mean? A lot of these startups, they might get their first couple sales through, oh, I worked at this company, my buddy's now the director there, that's our first account, or my cousin is a decision maker there, I got that account, and they think that they know their whole sales process, like they are the best salespeople ever, and then they have to start actually going outbound and actually having a sales process,
Mhm.
and they get run over because what happens? Um, I say two main things from what I've learned. One is they don't know their ICP or ideal customer profile.
Mhm.
Meaning, for example, they should be able to define, hey, I'm going after CROs or VPs of sales at companies that have between 11 and 50 headcount who are, in either internet technology or financial services. Like, you got to know your persona,
Mhm.
because otherwise you're going to be start getting all these calls and meetings, and you're just not going to. It'll go back to product market fit. If you're selling it to a CMO, like, I don't need this. I don't care for this. Or if you sell this to the CTO, they're like, I don't understand your value proposition. So one huge mistake I find is that people start to try to scale their sales without really knowing their personas or ideal customer profile, which
Mhm.
becomes a money pit because you're spending all this money top of funnel and nothing's converting. And you're finding out that the hard way. And one way to honestly avoid that pitfall is, again, talk to customers, right? Talk to early users. Talk to the CTO, CMO, CRO. Let them guide you and validate the fact that it should be the CRO and VP of sales. So I'd say
Mhm.
one pitfall is like, even the customers try to act like they know their personas. A lot of it, and again, I'm not. It is a process. Customer discovery is a process. You need to fail to succeed in this thing, right? But you
Mhm.
also need to think of feedback on like the persona, even the product market fit, whatever. All that feedback and all those, even I guess, rejections or failures along with successes as a treasure map,
Mhm.
right? Because if you take that feedback and say, you know what, okay, I A/B tested that demographic, did not work for us. That one was phenomenal. I can double down there. That's when you're like, okay, every time I get on the call with that exact persona, like 50% of the time we're closing business.
Mhm.
Now it's like, now you start saying, okay, how do we add more sales development reps? How do we add more account executives? What I find is when people even raise a couple $1 million, they just pour money into sales without
Mhm.
truly knowing their customer. And then beyond that, again, well, this is actually another thing, narrative. The way you tell your story is really important. So, like, there are certain products I've even seen where there might be multiple buyers. Okay, it might be a more technical buyer. Maybe it's like the CTO might buy this product, the CEO might also buy it, right? So when you talk to the CEO, there's certain things that you're going to say about your product that's going to get them excited and want them to buy. If you say the same thing to the CTO, they're like, I don't care, and vice
Right.
versa. So also, like, based on the persona you're going after, maybe even within the same product, putting them on the right product within the product, right? So, Michelle might care more about our CRM, whereas Anna's more concerned about our follow up automation or something, right?
Mhm.
So, like, another part of sales is that, like, when people go in there, sometimes they'll have like this. Now, I'm all about scripting. Don't get me wrong. You need to have a script as you scale your team, but some people go so hard to the script that they have like blinders on and they're not listening to their customers. And they're just trying to shove the sale down their throat. Whereas what they should be doing, and like I on my team, I don't have we never close I don't think we ever close a deal on the first call ever, like for our services. It's always
Mhm.
like, hey, let me hear a bit about you. Let me tell you a bit about me. Let's understand that, and then tell me what are some of your big problems. What are some of your big obstacles?
Mhm.
Okay, that's your issue. Let me tell you about how we can help with that. I'm not going to tell them about the other thing they didn't mention. That makes no sense. So that's the
Mhm.
other thing. It's like, I understand you have a product, and maybe if it's a very basic product, there's only really one solution. But making sure that in the sales process, like, you're listening, two ears, one mouth, right? understanding the customer's problem, and then putting them on the right product almost within your product, or the right solution within your product. So I'd say those are two biggest things. A lot of startups, I realized, they try to scale really quickly without really knowing their persona, and they burn a lot of money talking to the wrong people and trying to shove product down their throat. And then even when you do find the right persona, it's like having 2 ears, one mouth, listening twice as much as you speak, understanding their problem, and kind of retrofitting the sale to them. Even if you're selling the same thing to two people, the value in what might get it over the line for one person might be different than the other. And you're not going to know that unless you listen.
Right.
So, yeah.
No, I think that's great. And I love this concept of kind of like thinking about your interactions with, potential buyers, investors, whoever it may be, as kind of like a similar framework to product market fit, and, clearly defining those ICPs before going into those conversations. So that can kind of guide, how you address their needs. I think that's great.
Can I find one other thing? Sorry, just because we're on the sales
Yeah,
topic.
absolutely.
And I did not invent this. I'm not taking credit for it. There's many people who claim to have created this thing, but there's something called the straight line in sales, right? That's called straight line persuasion. So for example, internally, for example, on our agency, we have a script, right? When you talk to a prospect, there's a straight line. You need to essentially start at one point in the script, cover, hear about them, cover your introduction, listen, understand what their issues are, present how we could help. Then the next call to action is like, if they're interested, book a meeting. That straight line or that process needs to happen every time, because that's the other thing. If you don't have any structure, any script, like for example, the way I sell it versus one of my colleagues is going to sound different, but it's the same concept in terms of the straight line. They might use different vernacular. We're saying the same things, getting through that straight line process. Now, what happens is also in early stage startups, and why I'm bringing it up, is that if I listen to 10 of their sales calls, they are completely different, which is horrible. Because why? Even if you're getting some sales, eventually, if you're the founder selling, how are you going to train someone on that? If there's 10 different ways to sell it, you got to create a straight line. And with that being said, like there's something called coming off the straight line. So for example, I might be pitching Michelle on a certain service, and then she starts asking me about something that's not really related to deck design, but like I just kind of have to address it. So I'll say, hey, yeah, Michelle, in terms of the way we do X, here's the answer. And then I take it back to the straight line. So like what happens is sometimes, I know in sales calls, a lot of early stage founders is like, they'll get asked a question that takes them off the straight line. That's like a random question. And then for 10 minutes, they're talking about it. And like, even sometimes the prospect's like, all right, I already got the answer. Like you can stop now. Right. So it's like, hey, go address that and then get back to the straight line. What end up happening over time is you create what's called an objection handbook. And I'm going kind of deep here, but what ends up happening is you create an objection handbook, because I'll tell you this, across so many products, there's 5 or 10 objections to every product. It's not 100, it's not 1,000. There's like 5 or 10 things you're going to hear 90% of the time. So as a founder, as you're looking to like get out of the sales role and start to create processes and delegate it, not only do you have to create like a script that, again, people can kind of jam on it their own way, but you have to create a straight line. Then also to have a page of like Q&A, right? Like, right, they might ask you this, here's your answer. So you have those objections. Look, there's going to be a curveball here or there. You just got to figure it out. Worst case, what I do is if I really don't know the answer, that's a good point. I'm not quite sure. Let me take that offline, talk to my colleague, and I'll get back to you. Sound good? No one's ever like, no, I need the answer right now. Everyone's pretty logical at the end of the day. So, all right, yeah, go get me the info and come back. So, but just to recap, full circle, make sure you know your ideal customer profile. That's going to take some customer discovery, not going to happen overnight. Make sure that, when you talk to your prospects, you're creating, especially as we're talking about early stage startups, especially as an earlier stage founder, make sure not everything's just stuck in the back of your mind. Make sure you can document it and then delegate it, because that's how you're going to grow and scale. If you're a founder selling 5 years into the business, I'm telling you right now, you haven't grown, right? So you got to kind of do those things. And it might not be comfortable. You might not like scripting. It might sound kind of like, why am I even doing this? People just let them figure it out. I'm telling you, that's how you actually grow and scale. So even as a founder, you got to lose the ego, just reality, right? So
yeah. Awesome. I think that's a great way to think about that and kind of like tie in those concepts. So kind of thinking about the strategic elements that we've talked about so far, can you discuss some of the major challenges that you see early stage entrepreneurs face when it comes to raising capital? And what are some of the ways you've seen them overcome these challenges, especially with limited resources and team and network support?
Yeah, definitely. So in terms of funding, especially for like, okay, I'm going to answer this from the angle of, I'm a first-time founder. I don't really have that big of a network, because it's a very different answer than like, I've raised money. It's my second, exit. Like, yeah, you get money just because you are who you are. But I'm gonna go to the majority of people who are like first time founder, don't have all those connections, etc. So there's a couple things. One is, planting seeds, right? Especially early on. So like, it's funny enough, like one thing I was doing, there's this one investor I'm still trying to kind of court. So what
Mhm.
I'll do is I'll go on Twitter, right? I'll see them, they can comment, they'll post something, they only get like 2 or 3 comments. I'll be like, I'll jump in with a comment to the point where on certain threads we've gone back and forth, like making jokes and stuff, right?
Mhm.
I still haven't asked them for a meeting or anything. I'm just like planting seeds, right? So, like for example, that's a quick hack. Go, first of all, targeting. Okay, let's take a step back. Targeting. If you're a fintech, don't go target health tech investors. That makes no sense, right? At the same time, you don't want to be like so hyper specific that there's only like 3 investors that fit the your persona. You got to have some sense of volume to get to the meetings. Like they say, you need, according to DocSend, you need 39 meetings to raise your seed round. So you got to, it's almost like a sales process. You got to meet people. So a couple of ways I would do it virtually is, again, Twitter is pretty powerful. Honestly, a lot of investors hang out there. It's kind of like the platform for VCs. Like they want to kind of build up their reputations there. So really just like interacting with them. Like I go as far as having like a Google sheet of like some of like the more like top VCs I really want to get in front of at some point. And
Mhm.
like I just have a note there, and like whenever I have some time intermittently during the week, I'll pull that up and be like, let me go check out their Twitters, see if I can kind of plant a couple seeds there. And then eventually I'm going to DM them, right? So like that's one thing, right? Because now it's like, all right, you're not coming out of left field, Jason. You've talked before on Twitter. Cool, cool, cool. You've supported my content. I like that. Sorry, my computer. You guys hear me?
Yeah.
Oh, sorry.
Yeah,
It's
you're good.
Okay, so yeah, so that's one thing. And then another one is like, again, not to beat a dead horse, but events, right? There's industry events. If you see that a VC or a set of VCs that you're interested in is judging an event or is on a panel, go. You're gonna see them at networking, you're gonna shake some hands. I mean, for example, when I first started doing pitch events, that's how I got my first speakers. I literally went to other pitch events. I was like, hey, really thought you were great up there, some really good Q&A. Would love for you to, participate in our events. And like I built a relationship that way. So look, there's also other ways like LinkedIn. LinkedIn is really powerful, I will say. If you're all familiar with like LinkedIn Sales Navigator, that's like I think it's like $100 a month now, but you can get like a free month when you first start. If you go to lead filters, there's a lot of specific targeting you can do. So you could say, hey, I want to, like there's an industry one that says venture capital, right? Then you could go on Google, what are the main venture capital titles? Venture partner, analyst, associate, whatever, principal, plug those in, right? Maybe you're in New York, you plug in New York City, right, as the geo. Then in the keywords, because there's a keyword search in LinkedIn, you say, hey, I want the keyword fintech.
Right.
Boom, search. Then you start to reach out, right? So like that's just that's going to get you hundreds of leads right there on LinkedIn. So I'd say the 2 biggest ones, if you don't really know anybody, well, the 3 pillars I am personally applying myself as I raise money and I recommend are going to the events, right, where you know they're going to be. I know this could be hard to get to sometimes, especially if you're not like New York, but if that's applicable, for everyone, Twitter, right? Like building rapport, DMing. And then the third part of it, again, would be LinkedIn, in my opinion. LinkedIn's really powerful. And you can do a lot there. And honestly, with LinkedIn, I don't do it as much. I go a little more direct, but even there, maybe check their feeds and make some comments, like, right? Build that relationship. So look, it's not going to be easy, but it's going to be worth it. So it's like any other effort. You got to do something 100 times and maybe it works 5 or 10 times, but that 5 or 10 times or those 5 or 10 meetings can be all the difference in you being successful. So it's a grind, it's a hustle. I'm not going to discount that, but there are ways to figure it out, even if you're not quite there yet in terms of having your own extensive network.
Awesome. Yeah, I think that's great advice. Kind of like, again, bringing it back to like taking things slow and really being calculated and not jumping in without that strategic direction into those conversations. So that's awesome.
Actually, Michelle, one last thing. Even
Yeah.
if you get in contact with an investor through any of these platforms, and they say, no, not for me at the moment, what I'd always ask is like, oh, sounds good, totally get it. Like, as we get more traction, is it okay if I circle back and update you? Does that sound good? And almost
Right.
every time they're like, yeah, sounds great. And imagine you come back in 6 months, hey, we got 20K monthly recurring revenue. And they think, oh, wow, you did
Right.
what you said you'd do. Cool. Let's, and now you're that much further along in the conversation. So even when you lose, I'd take it as kind of a semi-win, because like throw that in a Google sheet or some sort of CRM and keep track of those people so that as things progress, hopefully you then have a network to go out to. Maybe there's 30 people who said no to you the first time, and you go back 6 months later, and then 3 of those people take a meeting, and one person cuts a check,
Right.
right? So, yeah.
Love it. All right. We are going to transition into live Q&A. So if you are in the audience and you have a question for Jason, please drop it in that Q&A box. We'll try to get to as many as possible. All right. So we have one interesting question. Can you talk a little bit about, like, if you do you have any insight on the differences and similarities between, funding and leveraging resources and like the ability to access, capital between a
Yes.
for-profit and a nonprofit organization?
Okay, so I will say pretty much everything I do is in the for-profit space. So for that one specifically, not really sure how things function on the nonprofit side. Um, but the first, can I maybe answer the first half of that question?
Yeah.
Can you refresh it really quick? Sorry, because when I heard nonprofit, I kind of lost track. Can you?
Yeah, just kind of thinking about how for-profits and nonprofits might think similarly or differently
Mm,
about, access to capital and leveraging
yeah.
resources.
Well, on the for-profit side, I mean, the way it usually works with startups, I'll put this out there, is like, and I know not everyone's in this situation, which is just kind of curveball, kind of broadly, but like a lot of people start with family and friends. Why? Or close professional network. Why? Because those people know and trust them. They're
Mhm.
betting on Michelle. They don't even care what the idea is. They're just like, you know what, Michelle, I know you're really smart. I'll throw in 5 grand. I'll throw in 10 grand, right? Like, so there's that in the super early stage. And then from there, it's like if you get some early stage angels, like as you maybe use that friends and family money to like build an MVP, and eventually you graduate to VCs.
Mhm.
On the nonprofit side, again, I'm not really an expert. I mean, I've seen stuff maybe in my community where like people will do like fundraisers and different events. So again, I can't really speak too much on the nonprofit side. I'm not sure if it really correlates as much to the for-profit side and how. And I'm speaking very specifically to like tech startups, right? So when I give you that example of the friends and family angel and VC, that's a traditional trajectory.
Mhm.
Um, and yeah, and again, the kind of the recommendations I made earlier on like LinkedIn, Twitter, events, like that's how I try to crack that. Not easy, but it's a hustle. And yeah.
Totally. That's super helpful. Awesome. We have another great question here asking about, how early stage founders might think about, their equity, how much to give away when, before raising a series A or B.
Yeah. So what I've seen is that, it's very interesting. There's this whole thing that goes around like the startup space where in terms of equity, I know a lot of people are like, hey, I want to be a solo founder because I want to own 100%.
Mhm.
And depending on the investor, sometimes that's almost like frowned down upon. Like I know groups I think like Y Combinator is like the best accelerator. I think almost in every case, it's like a 2 or 3 founder type of team. So
Mhm.
I'd say, look, general mindset, like if there's strategic founder who you really know can add value, maybe it's tech talent, maybe it's like, hey, I've worked with them in a previous business and they crushed it, and I know they could lead my sales team. You know, hook them up. Give them 10%, maybe 20%, depending on like how much, right? Like treat them as a founder.
Mhm.
Um, Now, in terms of like equity in general, one thing. So with early stage startups, it's really hard to create a valuation, right? It's kind of tricky. It's like, hey, I'm at the early stage. How much is my company worth? And that translates how much equity I'm going to give out. And that's why actually Y Combinator, who I just mentioned, created something a couple of years back called the SAFE agreement, the simple agreement for future equity. And the whole idea is like, okay, I'm an early stage startup. I don't know how much we're worth, right? I don't really know how much equity to give out to my investors in the early
Right.
stage, right? So what they say is, hey, I'm raising 500K on a SAFE with a $5 million valuation cap. And essentially the way it works is that the actual valuation that that first group of investors, which is probably where you all are at, are paying into is the valuation that gets determined in the next round of funding. So let's say in the pre-seed, you said 500K, $5 million valuation cap, and maybe throwing like a 20% discount because they're taking some risk, whatever. Now what happens is, let's say you go into that was the pre-seed. You raised 500K on a $5 million safe, um, sorry, with a valuation cap of 5 million. During the next round, let's just say you're valued at 7 million. That previous group, they convert it to 5 million because you went above that valuation. If you don't have a great round and when you go to raise the seed round, you're valued at $3 million, that first group converts at $3 million valuation. So to answer your question, in my opinion, the best way to handle that is to do it safe because it essentially like allows for your investors to come in with some expectation of like the max valuation they're paying without taking the risk of like if you don't do so well that like they're getting a worse deal in the next round of investors. So this is exactly why Y Combinator, being experts in the super early stage, created the safe. It's just like a black box early on. You don't really know your valuation. So the safe really helps. And I'm sure if anyone just Google safe agreement, that'll kind of go even more technical than what I'm giving you right now. But to answer your question, my opinion, it's almost like standard in industry now. Do a safe in the super early stage because it's a simple agreement for future equity based on what the company actually becomes when it's more realistic for you to give it a true valuation.
Awesome. That's super helpful.
Yeah.
Can you dive a bit deeper into the role that LinkedIn and email communication can
Yeah.
play in your sales strategy and how these communication channels differ from other available options in expanding your reach?
Definitely. So I believe right now LinkedIn has about 750 million people on the platform, right? So it's the biggest business community on planet Earth, right? So especially if you're in the B2B space or even raising money, it's a good place to get, become savvy. It's a good space, it's a good platform to be savvy on and know what you're doing. With that being said, I mean, I'll kind of just name drop it. There's a company, they're a little bit on the pricey side of the curveball. They're like a couple $100 a month, but it's like this software that we use internally. It's called Copilot. I think it's copilot.ai or copilot. I think just Google Copilot AI or and type in like LinkedIn automation. What we actually do is like we use some automation because we're an agency. Like our bandwidth's very important, so we just have to automate as much as we can. So like what we do with them, I was working on a campaign this morning with the team. Like we'll go into LinkedIn Sales Navigator, like I mentioned, produce that search of those 1,000 investors who are right on the nose. I take the search URL, I plug it into Copilot. It essentially starts grabbing leads. And every day it'll send like 25 touches. And think of the way it works as like a drip campaign through LinkedIn. So like we set like 3 or 4 automated messages. There's kind of a dashboard where if someone responds, we manually go in and talk to them. But instead of us sitting there like setting 25 messages a day, it sends those for us. And when they connect, it sends the second message. And then if they don't respond, it sends a third message. If they do respond, we go in and we talk to them and say, hey, and our call to action is always get them off LinkedIn, get them onto a Calendly or a Zoom meeting. So like our team, our sales development reps, once they see like a solid response, hey, sounds good, let's grab a time to discuss further. And we've been doing this for a long time. So we get, I mean, every week we have probably 30, 40 meetings a week as like an agency because we've been doing this for a long time. And even on the fundraising side, we've used it. We've gotten clients 5, 10 meetings off of LinkedIn a month, do this type of thing. So LinkedIn, again, all comes back to budget. I know this is about early stage bootstrapping founders. So I'm trying to be as price sensitive as possible. That's why I'd say maybe just do it manually early on and just hustle, just manually send 25 a day through LinkedIn Sales Navigator. And then email, kind of the same thing. Like we use a third-party software, Outreach Bin. The reason I like that one is because it warms up your email so you don't go to spam, and then it starts like the drip campaigns. Because that used to be my concern with cold email. I don't want to go to spam. So Outreach Bin, I think that's like 20, 30 bucks a month. You plug in your email, same thing like Copilot, but on email. You put in a bunch of your information, like the different 3 or 4 messages you want. Thing is, with cold email, also you got to find lists. A little tricky, a little bit of a hustle there. Like I'll give you a little hack we did. Like we found a database of like a ton of investors. I had my virtual assistant go in, grab them, give me all the emails. Now like we're targeting them to come onto our platform, right? So there's different ways to kind of skim the cat, but the short version of it is I do recommend automation to answer your question. I think that's the most effective thing because if you're sitting there all day and just pumping out emails, it's good. Let me throw out one caveat though. If it's a really high quality prospect that you really want to connect with, write a custom email, do a custom LinkedIn message. So it's all relative, right? I'm talking like scale, a broader approach versus sometimes you have to go sniper, right? And like research, like, hey, I know you have an event next Wednesday. Definitely want to come check it out. Or, hey, really love what you're doing in your newsletter. I'm following you on Twitter. Really love your last post about ABC, right? Hey, we have a community that does this. Would love to tell you more about it. So it kind of depends, but I'm talking more of like thinking like hardcore biz dev with kind of a complementary mindset of like being a sniper when you need to be, if that makes sense.
Amazing. All right. Well, we are almost out of time. Jason, if you had one piece of wisdom from this conversation or just from your business journey that you wanted to leave with entrepreneurs here today, what would that be?
Yeah, I'd say I hope that everyone really kind of pays attention to my point about surveys early on. Really just because, again, I need to be clear on this. Like, if you're serious about your startup, you're going to spend the next couple of years doing this. So if you get into the wrong boat, it's going to be like, you could row just as hard in another boat where like, you become a unicorn, but because you're in the wrong boat, you could end up wasting your time. So I just have seen so many great entrepreneurs who didn't validate their idea truly and then do surveys and these, again, simple surveys. I'm not overcomplicating, just do surveys, right? And continually do surveys. Once you get your first set of signups, survey them. Again, not everyone's going to fill out your surveys, but just hustle. You know what I mean? So that's the biggest takeaway. Low cost, no cost, do surveys, make sure what you're doing is worth your time. So your time is super, super valuable. So that's what I'd say.
Jason, thank you so much for taking the time to speak to our
Thank you for having me.
Share all of these insights on behalf of the NASDAQ Entrepreneurial Center and everyone here today. We are just so thankful you joined us.
Thank you so much. I appreciate you.
Awesome. And to our audience, we would love for you to join us again for upcoming webinars. which you can view using the link that's going to be posted in the chat. Thank you all so much for joining us today, and we look forward to welcoming you back online with us soon.